This is the Options Alpha platform. Excuse me, I thought I had that muted. This is the Options Omega platform. And these are some of my saved back tests. The ones that I'm going to want to focus on today with you guys are just using 2022 data. So from January 1 up till the last time I ran it, which was June 11th. So let's go ahead and look at this one. No, wait, that's a short call vertical. Let's back up. January 1 to June 8. Let's look at that one. All right, so there's an iron condor. The max winner is bigger than the max loser. Wins 19 out of 20 times, less than 5 days in the trade. Average win per trade was about $400. All right, that's not too bad. It's a good starting place. Now, I set this one at a $20,000 account, and I limited how much of the portfolio it could use. All right, so kind of see the returns. What I really like about this thing is you can actually see the trades. All right, because if I wanted to, I want to be able to go in and look at where those trades were, what the P&L was, all that kind of stuff. But this is what we're going to be focused on today. Now, I could just give you the settings and say, there, go do it. But that kind of defeats the purpose. You won't know how to adjust it. You won't know how to fix it or back test it or make it do something different than what I give you, right? So if it was just about giving you a fish, hey, great. I can just copy and paste the settings and you would be good to go and you would have yourself a fish. I would much rather show you how to use the fishing pole so you can get your own fish. So let's go ahead and get into it. It's called a weekly iron condor because we're focusing on next Friday's expiration. There is some background to this, which mainly comes down to the idea that one of the Tasty Trade guys, someone who used to work with Tom Sosnoff long ago, they built this Thinkorswim platform. One of those guys realized that there was a lot of options activity around the weekly expected move levels in the SPX, which is the most heavily traded product on the planet when it comes to options. It's back tested for everything. It is the experimental thing. And for years, it's had 3 expirations in a week. So for a long, long time, the SPX has been the product. And what this guy realized was that there was a lot of trade activity at the red line or the yellow line. It didn't really matter which one. And sometimes it was both. And so he started to dig deeper into that. As time went by, what he came up with is that the institutions were building strangles and or straddles and putting their positions at these lines. And what would happen because of that, especially back in the day, is that price would pin to these lines. It would stop there. It would react there more than it statistically should. So not only can we use this for back testing, not only could we use it for like analyzing the market, kind of getting an idea of what's going on a day-to-day basis, but we can also use it for trading. So what our old strategy used to do is we would build an iron condor using those lines because price will close inside of this box in the SPX more than it statistically should. That box is a 1 standard deviation, so it should close inside the box 68.2, blah, blah, blah. We just say 70%. It should close in there 70%, and instead, it's closing in there more than 80%. So it has already an inherently built-in win rate that it's staying inside the box, or if it leaves the box, it's coming back into the box by the end of the week, and that it wins way more than it should. That used to be all we needed for this strategy to work, just knowing that. But here's the problem, and why it quit working. So what we were doing is we would go in and we would build an iron condor, and we would set our strikes at those lines. That makes sense, right? We always need to know, like, well, what strikes am I going to get, and where does that put my break even? So we were building the strikes and we were putting the break evens on those lines. And before COVID, that was perfect. It worked very well. But after COVID hit, it quit working. So we got to get into the why of that. Why did it quit working? And what's the wrong logic here? Well, generally, if you are selling something, they say the more volatility, the better, because you will get more credit for the thing that you sell. In this situation, the more volatility is not helpful. And that's because we're still using the lines. And the lines got much, much bigger after COVID hit. So if this is telling me where to put my strikes, and my strikes end up very, very, very far out of the money, when we go to put the iron on, there's just no credit there, right? Even a $1 wide iron condor would end up with like 10, maybe 15 cents if you're lucky. And then, of course, everybody says, well, let's close down at 50% profit. 50% profit of what? 15 cents? Then what are you getting? 7? By the time you pay commissions and everything, you have nothing. One loss would completely wipe out any of those nothing gains. So the strategy just became broken. It no longer worked. But it no longer worked because the strikes we were picking were no longer appropriate, right? So the weekly iron condor used to be very, very effective. And it still is when we think about what price is supposed to do. Price is only supposed to move within a 1 standard deviation. That's all. Has anybody else got an audio problem? Orderly, check, check. Pinche güero que no sabe nada. Can you hear me now? I feel like a Verizon commercial. Can you hear me now? How about now? You hear me now? Somebody on YouTube says they don't hear me now. It's better? All right. Thanks, guys. Just checking. You know, it's we're going to be doing these for a couple of weeks. So we want to make sure that all of this is recorded and done correctly. And so I appreciate the feedback. For the person who lost audio, they can't hear me. So they don't know that it's on their end. All right. So let me demonstrate how bad it is now compared to what we used to have. And the easiest way for me to demonstrate that is just to draw a box around one of the weeks, right? So this is like 2 weeks ago. I'm going to just zoom in a little bit. I know it's kind of hard on the eyes when I do that, but we're going to do it. So that's the size of the box a couple of weeks ago. And that's pretty normal for the size of the box right now, right? I didn't choose like the worst one. I just picked one at random. And if we look at what the previous week was and the week before and the week before, it really looks like I've got about an average size box, right? We could just kind of drag it around. Heck, that week was way bigger than the week that I just covered. So it's about normal. Now let's take this back before COVID, and let me show you why higher volatility is not always better. So I'm going to take that box and we're going to just carry it back. We need to go back a little bit more. There we go. We're going to take it back before COVID. Look at the size of that box. The size of that box that you see right there, that's one of our normal weeks, right? That's just like an everyday kind of, well, that's the expected move for the week. That's huge. It's like 100-point move plus some, right? Well, back before COVID, the move was like 25 points. I just ballpark it here. Yeah, the entire move was like 82, right? And now the entire move is like 200 because it's 100 up and 100 down. So it is significantly bigger. Now, it's true. Tasty didn't lie to you. It is true. When you have more volatility, the things you sell are juicier. They have more price to it. And that is a good thing because if I'm selling it, I want to sell it for as much money as I can. The only issue that we're having is if we use these lines to tell us where to put our strikes, the lines will have us build this gigantic iron condor that doesn't have any money in it and it can still lose, right? Price can and today did break outside of these expected move lines, right? Here in this week, it broke out of those expected move lines. So you can never get far enough away. There's no such thing as getting safe enough or far enough away, especially in a high volatility environment. It's not going to work. So we need to build the iron condor using the same logic as we used to use, that price will stay inside of a designated range. And that if we can find the right range in the current market environment, we can still perform these mechanical expected move iron condors. So we still want a little more information about what's going on here. In 2020, I went live with 18 different mechanical trading systems. And by mechanical, I mean you don't need to do anything. You don't need to do technical analysis. You don't need to put your bias into it. You don't have to measure anything. And I ran them all the way through 2020. I did not know we were going to get COVID. And I don't really feel bad about that because the world didn't know we were going to get COVID. So it's not like I missed anything. In the later part of 2019, I developed mechanical systems. And at the start of the year in 2020, I went live. And then COVID hit, and that sucked. 18 different systems, all built on this weekly expected move indicator. Now, the indicator is not as accurate as hand drawing the lines. Mobius built this indicator for Dawn because Dawn said, well, I'm only doing it on the SPX. I only draw these lines in there. Well, what if I want it on Google or Apple or X Steel and it's Wednesday instead of Friday? How do I get the lines? I got to use the go back. I got to go dig through the historical records. And that's just a whole lot of work to try to get an expected move when you're jumping through charts, streaming, and trying to help people. So Mobius said, well, I can build you something that'll get kind of close. And it's only kind of close because Thinkorswim won't let us code where we can reach into this area and grab these numbers. So we can get kind of close, but you can never duplicate the exact numbers. Obviously, doing it by hand would be better, but we don't want to do it by hand on every single market out there. That would just be insane. So I'm going to turn the indicator off in a moment. Let me leave it on for just a moment, show you what it looks like when we hand draw them compared to using the indicator. There's a yellow line now in 3 locations, and then there's a red, green, gray line. Notice they don't match up. So the higher the volatility, the more that this indicator is going to be wrong, and that drawing them by hand will be more accurate. But when things are calm and normal and the market is just grinding to one side, they're going to be pretty spot on. I've had people say, hey, I'm trading on IBKR and I don't have that indicator. Does this mean I can't do it? No, you can still do it. You just need to know where the expected move is. Almost every single broker is going to give you this data. If they are proclaiming themselves to be an options broker anyways, they're going to have that data. But what if they don't? Well, there is some cheat sheets to that, right? There is a little bit of a quick fix because, back in the day when we were trading options, I say we, but I wasn't trading back in the day. Back in the day when the old dudes were trading options, they didn't have those, right? That's kind of a newer development. So how would they get expected move back in the day? They would actually run this cute little formula where they would like buy a strangle, not actually buy it, but price it. They would price a strangle and then they would multiply that by like 1.25 or 0.85. And whatever that number came up to, that's what they would use for their expected move. So if you're on a platform that doesn't have that, you can get it. Don't worry about it. Otherwise, if you're on, say, IBKR, it has that. But what you have to do is get it on the weekend because once Sunday night hits and the futures start to move, your SPX implied volatility expected move range is going to change. So you got to get it on the weekend when the market's closed. And if you miss it and you're not on Thinkorswim, you are SOL, which means you got to be a member of the Bullish Bears. You got to come in and say, hey, Sig, what's that line, man? I don't have it. And then, of course, I'll dig it out for you and I'll give it to you. So don't really, don't stress on it too much. All you got to do is just be a member of the Bullish Bears. We'll get you hooked up. So we know the why now, right? We know what we're trying to do. We want to put an iron condor on a Friday, price it for next Friday, and close it out before it expires. We never want to hold these to expiration. It's not worth it. We also need a way to mechanically decide where we're going to put the strikes. And the reason that I ever developed mechanicals in the first place is because when I started trading, I had a full-time job. My job did not like to see my cell phone in my hands. They hated it. Every time I pulled my phone out and there was somebody there, hey, what are you doing? Why are you looking at your phone? You're supposed to be working. Shut up. And I had an office job for a little bit. And they certainly did not like it when I used my office computer to poke around on the internet, looking at stocks and trying to see what was going on out there. So I could really only trade at lunch. And I could trade during these little 15-minute breaks that we would have. Well, a trade strategy that's mechanical, where I don't need to do technical analysis, is perfect for that. And I didn't mention it, but when I was new, I didn't know how to do technical analysis, even if I wanted to do it. I just didn't know how. I was new. Even after having traded now for a few years, technical analysis is one of those things that you could wake up and learn something new for the rest of your life. It never ends. If you're a nerd like me and you want to learn something new, there is always something there, and there always will. So you won't ever reach a plateau where you know it all. I kind of like that. But on the other hand, I need to make money. So we need a system that works, even if you don't know how to do technical analysis. And we need a system that works, even if you don't have the time to perform that technical analysis. And then we need to know that it works in this environment, because I had one that worked and it worked really good and it was great. And now it's broken and I can't use it. It's been broken now for over a year. And I really didn't have any way to solve the problem. There are backtesting systems out there besides the one that we're going to use. And they're okay, I guess, if you're running some very vague, very generic backtest. But man, when I got money on the line, I don't like vague, generic backtests. I want accurate information that I can check and double check and prove, okay, this thing is spot on, it's right, it's working, I trust you. Not some random end of day junk that doesn't tell me, hey, what did you trade? What strikes was that? When did you get in? When did you get out? How much of my portfolio was that? So we need real answers. Otherwise, it all just doesn't work. Now, the back testing that we're going to use doesn't have this logic in it. It doesn't use expected move. So we have to solve this problem. If I can't use some button to push that says I want my strikes at a certain expected move, then I need a way to kind of round out or approximate where this location is so that my strikes are still mechanical. I don't want my feelings or my gut or my intuition or how I feel about the news. I don't want any of that. I just want something that says put your strikes right there. So if our back tester doesn't have this, we need to figure out a way to identify what the average location is in the current market environment for these lines. And what that gets us, and I'm not done, all of you can do this on your own too. It gets us around a 25 delta on the put side. Now, here's the cool thing. The creators of this back tester, they listen to you guys, right? Not just me. I mean, they listen to everybody. So if they find a way to do it, or if they have enough people talking about it, they may find a way to do it. They can put that expected move in. Not because they have some square root of time formula or any kind of crazy access to that stuff, but because if you build a strangle and then you multiply it by whatever percentage the tasty says to multiply it, you're going to get a very close approximation of an expected move. So they've already got that kind of data. If I wanted to run a back test on a strangle, I could do that. So it can already price that for me. If it can price it for me, then it can give me an expected move. So someday in the future, hopefully one of those guys will figure out in their mad science wisdom how to put this in. But until then, we just need to figure out where we're going to put our strikes. We're in a bear market. So I focused on the put side. That's part of the reason I wanted to talk to you guys today before we just jump right in and start testing things. I need you to know how to adjust this back test later on so that when we go back to a normal market environment and you say, hey, Sig, that ain't working anymore. Yeah, but you know how to do it now. We will want to go back in and look at those expected moves and look at the call side. So to demonstrate what I'm talking about, let's look at next week's box. It's Friday. I kind of chose Friday on purpose because I knew there would already be a box for next week. It says that the put side is at 37.94. Well, we can't trade an SPX option at 37.94. It's going to be 37.90 or it's going to be 37.95. So let's go in and see where 37.90 and 37.95 land us. Right? And of course, that's the put side. So we're just going to go out a week, 7 days from today. 37.95, and we need a delta value. That puts us at about a 21 delta. If I was taking averages, and I know I'm going to do a Captain Obvious thing here for a second. I've had someone tell me more than once, math is stupid. Yeah, maybe math is stupid, but if you're going to be a trader, you better know how to do it. How do you get average? You add together occurrences and then you multiply by whatever amount of occurrences that you're using, right? So if we were to take the last 5 weeks and we took that number and say it was 21 and 25 and then 25 and then a 27 and we just kept doing that until we got 5 weeks worth of numbers. We'll get one more in there. We'll get an outlier like a 15, something stupid. If that was my 5 weeks and I wanted an average of those 5 weeks, the way I would get it is to add all of those numbers together and divide by 5. That's how I would get a 5 week average, right? And it could be 5 week, 50 week, whatever we want. So right now we got a 21. If we were to look at last week's, we would have to go into the go back. That is kind of a think or swim thing, but we can do it. What was the top line last week when it was the Friday before that. So on 6/17, what was the expected move put side line? All right, so we got to use the go back. We go to trade, analyze, think back. We need the 16th. Bum, bum, bum. Notice the 17th is blocked out. Not sure what's up with it. We'll try the 17th, see what it gets us. That was the holiday, right, guys? We didn't have a Thursday expiration, did we? So the third Thursday of the month was the 17th. That would have been OPEX. Surely I didn't forget about that, right? So that's the 17th, OPEX. 7 days later would be the 24th. What was the expected move for that put, right? Where was that delta value, not the expected move? I seen you typing in there, Namita. I seen it. So first we need to know where the line is. Go back out there and get it. 35.70. 35.70 was a 26 delta. So now we got two numbers. We got a 21 and we got a 26. Now we can keep doing this. I've already done it because I knew I didn't want to spend, like an hour going back and getting these numbers. I've got quite a bit of results. On 6/3, the put side delta was a 2023. On 5/27, it was between a 21 and a 22. You see how I just kind of jumped ahead and I got all this information. So I got it, but I wanted to show you how I got it because I want you to be able to go and get it too. If you're not on Think or Swim, you're going to find it very hard to get that information. I'm sorry, I don't know how to tell you how to fix it, right? Other than just join us, come in and ask, I'll give you what I got. So you want to use the back tester if you're trying to find where these lines are, because remember, at some point we're going to turn into a bull market again. Not anytime soon, but we will eventually. And you're going to want to know how to fix this. At that point, you may want the average call side line rather than the average put side line. And hey, maybe by then, Option Omega will already have built in a way for you to use expected move. Expected move is a very, very powerful tool, and it's a large part of how the options marketplace works. And I'm almost positive that they don't already have it in there because they probably believed the only way to get it is through implied volatility values, and bringing in all that extra data would probably break the machine because it's fast, guys. You run a back test on Option Omega and that sucker moves. It's awesome. But if you start piling it up with a bunch of extraneous data, it's going to just bog down and fall over, right? Fall out of bed. We don't want that. But if they can use the strangle to give them their expected move values, then they didn't have to bring in any more data. They only had to use the data that they already had and just use a little bit of code that says, put these two together and give me the number, and I'll use that number for an expected move. I made that sound really easy, but I bet it's not that easy. Thank God I'm not a coder. Before we start back testing, is there any questions on what I've covered so far? And I do have videos on this stuff. So like if you go to the next level library and you look up weekly options or weekly expected move, you'll see this indicator. You'll see a lot of videos on it. I've covered the discussion about the indicator a lot. All right. So I'm going to point people in that direction. But before we start back testing, I want to make sure everybody understands what we're trying to accomplish here. We want an iron condor for next week, but we can't use these lines on their own, because if we do that, it's going to build our break evens way too far away. So we're going to use an approximation of those lines by picking a delta value. And then we're going to start to turn the knob and see how to dial in this iron condor so that it will win with an appropriate amount of money to make it worth our time and make it mechanical so that we don't need to interpret or analyze or validate some candle chart to make a decision on whether or not we should put it on. And if there's no questions, then we'll just start getting into that. Now, while I'm giving everybody time to type those questions in, this is not the only video that we're going to do, and this is not the only time we're going to do it. I had 18 different strategies that I was using before COVID. I want them all back again. When I built them, I did them all on my own. I was just, sitting in the office late at night, nerding out, doing my thing, listening to Seeger and just doing my thing. Well, now that we got options Omega and we can do this work, I really didn't see why I would want to do it by myself. Because if I can share it with you guys while I'm doing the work, then we can use it for a learning tool. You'll know what it is that we're trying to accomplish and the steps we took to accomplish it so that later on, if it breaks again, and it's not even an if, it's when these break again, you'll know how at that point to go in and run your own back tests and turn the knobs and get it to where it works again. Right? So there's verticals, calendars, irons, and butterflies that we're going to be working on. Today, we're not going to get to all of those, I promise, because I don't want to stream for 5 hours. So we're not going to get to all of them, but we will get to all of them in the coming weeks. We're going to continue to do this every week, working through one strategy at a time until I've got all of my 18 strategies back. And the good thing is, along the way, instead of doing it privately behind the curtains and just giving you the results, I'm going to do all of it live so that you can see where the mistakes come in, right? We learn a lot from the mistakes, where the mistakes come in, and then, where the good stuff comes in. Where's the money at? Now, I'm no expert on running options Omega. All right. So if you want more information about how to use it better than I'm going to be demonstrating today, check out their YouTube page. And I'm certainly not doing a commercial. I don't do it for any other place. I'm not doing it for these guys. But they've got some great videos, and you have to subscribe. I know this sounds like a video. Damn it. You have to subscribe because I swear every other day they're coming out with a new update. Which, I mean, you gotta kinda like that because, you know, I've got a lot of apps on my phone that somebody made this app and they threw it out there and then they never updated it, they never fixed it, they never made it better. They're just like, "Whatever, I'm selling it and I'm making money, so it's good enough." I hate that. I hate that. This keeps updating. They are forever creating better user experience, more data, more information, better user experience. And unless you're a nerd like me hanging out all the time, you need to know when they make updates. So just hit the button, right? Like I've never done that before. Just hit, there you go. There it is. Hit the button so that you will know when they come up with new videos. By the way, if you buy their product, you get their Discord. Now, I'm not talking about a Discord that has, 5,000 people in it and it's super chatty and it's just this non-stop scrolling Discord. It's not like that. But it is full of a bunch of nerds like me who are turning the knobs and pushing the buttons and trying to figure out a better way to do it. And I got to admit, some of the people in this community, they do not trade like me, even a little bit, nothing like me. And yet some of their results are surprising, really, really surprising. I've put a couple of trades on based on their results because you can share your results. You can share your strategies and your scans and your setups and your settings. So you're not alone. I really like that. And there's more than one way to skin this cat, right? We're all trying to figure out a safer way to trade and better results, more money, less risk, right? That's kind of like that's the unicorn. That's what we all want, that mythical creature where we win a lot of money and we don't have to put a lot of money at risk. So, once you're a member, just jump in here and say, "Hey, I'm new, but I'm a subscriber. I'm paid," and they will unlock your material. You'll see all the rest of the channels that you won't see when you first show up, and you'll be there, right? And if you're in there when they make a new video, they let you know. That way, you don't have to worry about missing it. So let's bring up the platform. We want a new back test, and I actually want to start like brand new, right? So this is one that I already had. So let's just go like totally new. Just look at tests, created a brand new back test because looking at something that I already had really doesn't help you guys out. Now, you don't get to choose everything out there. So Tradeovate doesn't. Um, Tradeovate doesn't offer you all of the options. They're a boutique broker specifically designed for futures, and they offer just a little bit of futures, but not even all of the strikes. So sure, they do have options, but they're only options on futures, and they're only some strikes. So if you're going to want to do options on futures, you're going to want to really use something like Tasty Trades. Tasty Trades has complex options, and they're one of the few brokers that do. You can go to Thinkorswim and IBKR and all these other brokers that have options on futures, but they won't let you do complex spreads. You have to leg in and then leg out, and then you have to leg the roll, and that makes it really difficult. Tradeovate doesn't even offer you all of the strikes, so you can go like 10 out or 12 out. But I sell options on futures all the time, and when I was looking at Tradeovate to sell options, they wouldn't even let me go out as far as I wanted to go. I want to sell MES at last year's highs. I don't want to sell MES 10 strikes out. So it really is useful to get more brokers. I've got 15 different brokers, which that sucks because you got to learn every new broker. But each broker has a benefit and a negative that I like and I don't like. There's no such thing as a perfect broker. And if there is, I haven't found it. So you just got to kind of resign yourself to the idea that if you want a specialty broker, you're going to have to go get more than one. And I know it sucks. It's sucking in a new broker. The choice is to get a boutique broker, which is what it's called, right? Getting a specialty broker. You get a boutique broker for a special thing, or you get a general broker that does everything. Thinkorswim is a general broker that does everything, but they'll gouge you really hard if you try to trade futures there. Futures options aren't any better, but definitely futures trades. They'll gouge you in the commissions. So there's no perfect world. When it comes to the back test, they've been slowly adding numbers, or not numbers, but names to this. I've seen their top 5 list, and I believe I don't want to speak out of turn, but I believe that the next name that they may add to this list won't actually be an index. It will be an equity product. I'm not going to say the name of the equity product because if I'm wrong, then it's just going to look really bad. But they've already got the S&P and the IWM, and they've got the NASDAQ. So unless they're going to add the Dow next, and I mean, they might, but that thing's really not liquid. then they're going to want to focus on the next product out there that hits the top 5 or the top 10 in options liquidity. For anybody that don't understand why, if you're going to backtest, or hell, even if you're just going to trade, you want to trade the most liquid stuff. The more illiquid it is, the worse your pricing is going to get. Well, that's bad enough to trade, but imagine how worse it is trying to backtest data when it's a really wide bid-ask spread with no liquidity. So, if their goal is to yet continue to add names, and as far as I know, they're slowly working on doing that, then they're going to continue to focus on what is the most heavily traded options products in the world, right? So whatever's next on the list. And for any of you who's been trading options for a while, you already know the next name on the list. I'm not going to say it. But these are what we got right now: SPY, SPX, IWM, and the QQQ. I like to use the SPX, but I do have to say, when I was new, I was not allowed to trade this. I made that for my own personal set of rules. This thing will rip your face off. It is mean, it is violent, and it is not forgiving. And it's not as liquid as SPY. I know everybody wants more money, but I mean, you can add more lots. SPY is so liquid, it's so awesome that you can literally market order in, and the slippage from your market order to get in would still be better than trying to work the order to hit the mid to hit the SPX. So you may as well trade something that you can market order into, the SPY. And if you want more money, just put on more lots. My broker caps my lots out at 10. So as far as my broker is concerned, if I put on a trade with 50 SPY lots, it's no different than 10 lots. I don't have to worry about the commissions past 10. And my broker is tasty. But either way, SPY is the most liquid product, but the SPX does have benefits that SPY doesn't have. For one, SPY does not have 5 expirations a week right now, and the SPX does. 2, the SPX is a real index, not a man-made mimicked ETF of an index, which means you can't own it, you can't buy it, and you can't be assigned because of that. So, no shares to worry about. If you end up with options in the money, it's cash secured. Right? That's it. You're done with it. So there are some benefits, right? Plus, I mean, this thing, the amount of money that this thing moves around in its options is just phenomenally nuts. But we're going to focus on the SPX. I do want, for right now, to focus on year to date. The reason for that is our system quit working. We're going to come back out to the chart for a moment. This chart right now is year to date. And even though I don't really need to add it, I'm going to add the linear regression line and just start at the left and go to the right. It is in a downtrend. Hey, thanks, Captain Obvious. Yep. It's not going to end anytime soon, too. This is the first time we've been in a sustained bearish move to the downside that was not just market related in over a decade. We've had downturns in the market, but they were candle related. The Fed could come in and give it a shot of volatility and it would just rise right back out again, right? Just pump more money, it'll be okay. Well, they can't fix it this time. In fact, they are going out of their way, deliberately beating it down, keeping it down. They don't want it to go up. So we have to approach this completely different than anything else we've ever had in my time of trading. It's not something that's never happened before. I got to say that, right? It's just never happened for most of us. I wasn't trading in the '07 crisis. I was still working on the drilling rigs in the '07 crisis. So we're only back testing today. This time frame from year to date forward, because that's where we peaked out and we've been running downhill ever since. We will expand the trade, right? We will. We're going to expand this trade and we're going to look back at previous years. But if we wanted to do a full history of the market, Tasty Trades did that already. They put in a lot of time and effort to ask, what is a good standard 45 days to expiration iron condor that would work in the last 20 years? Okay, I mean, that's a good starting place if you wanted like some generic full on 45 days to expiration, full duration iron condor. But that's irrelevant to what we're working on, right? So we don't want 10 years of data. We don't want 9 years of data. I don't even want 3 years of data. I just want to know the iron condor that I'm using right now for a week to week, that it works with the kind of market that we have right now. I don't care what it was 3 years ago. I only care that what I'm using now works. So we set the start date year to date, nice and simple. Although, I mean, 90 days, fine. That would get you right past the Fed meeting, but year to date. And it's a drop down menu. What would you like to do? Do you want to do a calendar, a butterfly, a double diagonal? What do you got? What do you want? I want an iron condor. Now, when I was getting taught how to use this, I already mentioned that I work with a lot of newer traders. And if we were just going to choose something like a butterfly or maybe a vertical, they very likely would build it in the wrong direction. Which one should be the buy? Which one should be the sell? And that if they could put a little picture there, that would help out a lot. It's the feedback was they had already thought about doing that when they first put this thing together. And then they thought, nah, that's kind of cheesy. Let's go ahead and take it out. It looks more professional without it. And I got to say, the nice, sleek lines, it looks professional. But I can already assume that there's going to be people that are building it backwards and then they're getting results that they don't understand. So there's been talk about them putting it back in. But for right now, just make sure you're building it the right way. We want an iron condor. And I want to focus on the put side because we are in a bearish market. My stats for the average red line on that weekly expected move was that the red line showed up somewhere very close to a 25 delta. Don't hit the enter button. It just automatically brings the test in. So a 25 delta. Now I'm going to build these really small. So we just want to go $5 wide. And I'm going to start with 25 delta on the call side, that it would be not equidistant. Let's do this backwards. Do it again. Kind of got myself all backwards when I was talking about equidistant. All right. So if you don't understand what equidistant is, that's what I get for just pushing buttons while I'm talking. So let's talk about an iron condor and what equidistance looks like. Just going to randomly pick a day. We're just going to go up here and say, give me an iron condor. There's two things about an iron condor that are important to pay attention to. One is how wide is each of these credit spreads? If each credit spread is $5 wide, then your iron condor is balanced. But how far away from price each of those credit spreads are will determine if you're delta neutral or not. Now, once you've put the trade on, you won't keep delta neutral for very long. But if you want to be equidistant from the middle, If you go 2 strikes out of the money on the put side, you need to go 2 strikes out of the money on the call side. That will help you stay equidistant. But what if your slant is slightly bullish? That you're worried the market is going to challenge your call side more than your put side. Well, then bring those up a little higher, right? And then, of course, you'd have to bring your puts up a little higher. So now you're no longer equidistant. You're 1 strike out on the put side, you're 3 strikes out on the call side. When we look at it on the curve, wow, I got to turn off a bunch of stuff. Boom, boom, boom. There we go. Do it that way. So there's that iron. 17 days to expiration. We just want to talk about an iron for a minute. So it doesn't matter what expirations we have. We just want to be able to throw something on there so we can look at it. Price is right here, and that is not in the middle of that iron condor, right? We handicapped it to the upside. If we thought that we would be challenged in an upside move, we may want to set those calls farther up. But if we set the calls farther up, we got to bring the puts up. Or do we? Could we just leave them where they were all along? And that would just give us an even wider iron condor. These are all the things that need to be checked and tested and validated. If we wanted it equidistant, or delta neutral is probably the better way to say it, then we would want to build it where price is landing right in the middle as much as it can be, right? And something like Think or Swim will actually tell you that you're at delta neutral. So will Tasty. You can see we're at a delta of 0.03, and that's really close to zero. It's good enough. But if I kick it off to one side, right? If I drag one end, say the puts down or the calls down, I'm no longer delta neutral, because now I'm handicapping the downside. I'm offering more room, because if I'm scared that it's going to make a downside move and break the bottom of my iron, I may want to start the entire trade handicapping the put side. Now, an iron condor is just a word. It's not a fact, right? So if we were just to go in and build a put credit spread, and later on we were to go in and add a call credit spread, we would now find ourselves in an iron condor. They call that legging into an iron, by the way. But if we did that, our outcome would be, hey, now I've got this iron, even though we didn't start it as an iron. It's important to realize that, because if you run across someone and they call it an iron fly instead of an iron condor, they may be mistaken on what an iron fly is. They may call it all kinds of things. But as long as you know what the shape of it is, whatever they call it won't matter. Is there a call credit spread, and is there a put credit spread? And are they the same width apart? Is that a $5 put credit and a $5 call credit? As long as they are, then it's just a regular iron condor, and it may or may not have started delta neutral. Of course, once you put it on, it won't be neutral for long, because price will run towards one side or the other. If you kick off one side, so now we've got a $10 wide on one side and we've got a $5 wide on the other side, you can see that we no longer have an iron. And we've now taken all of the risk from one side and we put it on the other side. So those are the consequences if you get to messing around with the size of the iron condor. And there's nothing wrong with that by any means. It's okay. But what we want to focus on today is just a regular weekly iron condor. How did we start it? How are we going to fix it if something goes wrong? All of that. So what I've told this back tester is to use just 22, and we want an iron condor built on delta. there are choices. But since we're trying to approximate where those lines are on the weekly expected move, and we've already decided that around a 25 put delta is where we want to be, whatever that gives us on the call side is just what it's going to be. Is that right? Well, we're in a bear market. What it ends up giving us is a skewed iron condor, or an iron condor that is handicapped to the downside. So let's look at delta. I got to add more strikes. We're going to scroll down to a 25 delta. And we're not going to use the 17th. We actually want five days to expiration, or excuse me, 7 days, right? Because next Friday. So 7 days to expiration, a 25 delta. Got it. There's my put. I told the machine to go $5 more or 5 points out and give me the call, or the long. So I've got a short, I've got a long, I've got a put credit spread built with a 25 delta. And then I told it, well, just give me the same thing on the call side. So let's go to the call side, run the deltas. There's our 25. We build a call credit spread there. And now we're going to look at it on the curve. And just kind of zoom out here. That is a very wide iron condor. We are risking 265 to make 235, or 260 to make 240. It's only $5 wide, right? So all the numbers will equal 5. If we take 240 and 260, it makes $5. If I'm getting 250 in credit, then I'm risking 250 to make 250, right? So everything, it's like an algorithm, or an algebra equation. A plus B equals C. C minus B equals A. All of that kind of craziness. We are very close to being in the middle. So we're not really handicapping either side today. However, in the current market environment, we do want to recognize that there is a little bit of a long tail skew right now on the S&P. What does a long tail skew mean? Well, if you think about standard deviation, how do we get it? It means that 70% of all of the transactions, or all of the volume, or all of the action is within that one standard deviation range. Well, generally speaking, people don't fear a market going up. They fear a market going down. So normally in the S&P, they would be trading the put side. They would be buying puts because they're scared of a market going down. And that would give us a short-tailed skew, or a long tail on the short side. I don't know how you want to say it, but this area right here would be longer than this area here, because there would be a lot of out of the money put buying. And right now, we haven't had that in the last week and a half. There's been a lot of out of the money call buying. And so what we've ended up with is a long-tailed skew. So that's one of the reasons that today that delta on the call side is lining up to be pretty equal, so that we ended up with a delta neutral trade. But that won't always be true. Should we choose a different number for the call side? Maybe. And if we don't like the results of the back test, that would probably be something I'm willing to change. Because right now, we're only using 25 on the call side because we used 25 on the put side. And that may come and kick us in the face later on, right? So if we start having issues with the back test and it's not giving us answers that we want to start looking at the call side and asking some questions. Is that where we are getting hung up? Right? So back to the back tester. We're in a bear market. So I'm only focusing on starting everything with that put side, because that's what we're working on. When we get back into a bull market, you may want to go in and get that average line delta and look at what the average call would be, and then make the decision if you want to run it that way. We're doing one of each. It's not like a butterfly where we, do like 1-3-2s or 1-2-1s or any kind of complex system like that. It's 1-1-1-1. And we are going 5 away from our delta location. The next thing that we need to get right is the days to expiration. I want it for next Friday. So then the next thing we got to worry about is, hey, when are we going to put this thing on? And I remember when I first built my version of this and I took it over and I threw it into the Options Omega Discord, everybody's seen the results and said, I like that. That thing looks like it makes a lot of money. What was the reason you put the trade on? Like, what were you looking at? Was there something on the candle chart? Was the VIX doing something? What was the criteria? The clock. I just look at what time it is. It's not a normal answer, I can tell you. Already, I teach a lot when it comes to trading, and I'm constantly talking about the clock. Look at what time of day it is, especially if you're going to intraday trade. And I get a lot of pushback. People say, well, I want to look at the RSI and the stochastics and the MACD and the VIX and what's going on in the bonds and the dollar. What time is it? It's a really important piece of the puzzle. The entry criteria for this, 9:45 in the morning. Now that, I got to tell you, was a little bit of a surprise, because what we used to do is we would wait until the afternoon, the later part of the afternoon, and we would get as close to the end of the day as we could get. Remember, you're filling 4 legs, and that's not always an easy thing to do, even in a liquid product like the SPX, because we're out of the money and it's 4 legs. So we would start trying to fill these at like 2 o'clock in the afternoon. And if we could, we would get closer to 3. I mean, we would get as late in the day as we could. So when I first started running my back tests, that's exactly what I set the thing to do. Look in the afternoons. And I got to admit, I didn't like the results. They sucked. I knew the system was good. I knew that my strategy used to work. So once I had exhausted all the other things that I could change and I still wasn't getting the results that I was looking for, I started to dial back what time of day we put the trade on. And instead of trying to putting on in the later part of the day, I actually started trying to put it on in the earlier part of the day. Now, if you've been trading options for a while, this might help kind of try to understand why. Remember that these are time-based trades. And if I'm putting it on in Friday afternoon, then I just missed an opportunity to burn an entire day full of theta. I missed Friday. Right now, we don't know when theta is applied. If you've ever heard Tom Sosnoff talk about the theta question, he says, as a broker developer, they wanted to make it as random as absolutely possible so that nobody could ever game the system. So theta is applied through this randomized process of how much it's been traded today, how much liquidity, what the dollar value of the stock is. There's all these different criteria, and then suddenly, poof, out of the blue, theta gets applied. And they made it so complex that nobody could ever cheat. And it changes constantly with all these different parameters. So we can never say for sure when it's applied. Friday's theta will be applied at some point today. That's all we know. For all we know, it already has been applied, right? Maybe we missed it. Plus, it's not going to happen all at once. They're going to milk it in there a little bit at a time, just like your all your other Greeks. They always say things like delta is the rate of change for an underlying market in a $1 move on the option, right? But it's not like you blinked and it went $1, because that's not the tick size. The tick size is 1 penny. And every 1 penny increment, they recalculate the entire formula. And they say, well, from here, You got a binomial system. It's going to go up a penny, down a penny. And once it does, it's going to readjust everything and say you can go up a penny and down a penny. So even delta is not applied by the dollar value. It's applied by the penny. But that would just hurt our brain trying to figure that out, right? So circle back. I readjusted the time frame. I got rid of that afternoon stuff and I applied it first thing in the morning. Now, once you start using it, I encourage you try different time frames. You'd be surprised at the outcome. You would be surprised at how much that mattered, right? Not what the level of the VIX was, not if we were in a bull market or a bear market or what my data values were. It was what time of day did you want to put this trade on as early as possible. I didn't choose 9:30 because I trade options and I know that trying to get filled at 9:30 is a joke. You're going to get ripped apart. So I chose 9:45. And I got to say, I don't think we're done. I'm going to play around with it. I think 10 would probably be better. But we're going to leave it at 9:45 for now. And I just wanted to explain why it's so early in the morning when anybody who's heard me talk about this before knows we go for the afternoon, right? We want it on in the later part of the day. But the reason we were putting it on in the later part of the day was because we wanted to be as accurate as possible with those lines, right? Remember the lines that we were talking about earlier? Right now, the market is still open and these lines are still moving. And at the end of the day, when the market closes, they're going to stop. They're going to get locked into place. So we didn't want to put it on first thing in the morning when the line was way down here and then have it run all the way up and find the line way up there at the end of the day. So we were putting it on as late as possible. But we're not using those lines anymore, right? Because the options Omega backtester doesn't have expected move built into it. We're going to use a 25 delta for our put selection. And we're going to start the trade at 9:45 in the morning. And we're going to do it every week on a Friday. Now, the really cool thing is when we get to getting into things like my butterflies and verticals, we'll be able to do them every single day of the week because the SPX has expirations every single day of the week. That is so cool. I love that product. But for right now, Friday, 9:45 in the morning, and it's done once a week. And we're going to use 5% of the account. The account is the $20,000 account that I'm currently using here on Tasty, this one. Now, these trades, if it was a different strategy, we could actually have overlapping iron condors. We wouldn't have that in this strategy because every week before we get to the new Friday, the old one is going to be gone. So we don't have to tell it how many max trades that we want to have, how many max open trades, because that's not really an issue for us right now. Later on, it could be in a different strategy. How many contracts per trade? This is more about the lot level. How many lots do you want? Because what you're going to see is when I hit the go button, if you've got $100,000 in that account and you use 5% of it, it's going to try to fill you with 10 or 12 or 15 of these iron condors. And that's going to freak a lot of you out. You're not going to be interested in putting on 15 iron condors all at once, right? You're not going to be interested in putting $20,000 on the line. So you may want to go in and tell it exactly how many you do or don't want, right? What's your maximum allocation? How many irons do you want? I don't need that because it's a $20,000 account. I don't need any of these. We're not using any technical analysis. We're not putting indicators on this. No MACDs, no moving averages. You do have those kind of choices, including the dark pool, the gamma, the GEX, and the DEX. We're not using any of that stuff, right? So we just leave it all turned off. Now the target profit. We're going to get into the meat of it now. Everybody asks me this question. Hey, Sig, I sold this thing. Doesn't matter what you sold. Baseball cards, widgets, you sold a rock, whatever. Hey, I sold this thing. When do I buy it back? How much profit should I go for? You're right to ask the question. It does matter. It really does, but only to a point. And depending on who you ask, you're going to get a different answer. Um, Thinkorswim has webinars, and they have this really awesome lady. Her name is Barbara, and Barbara teaches um, small account options trading strategies, including iron condors and credit spreads and things like that. Now, she's aggressive. She likes 80% profit. She's smart. She knows her business. She literally works at TD Ameritrade. When they sold Thinkorswim, they hired a bunch of CMT analysts and they ramped up their education department. And she's been doing it for a long time. And she says 80%. Is she wrong? Nah, I don't think so. Not even a little bit. I don't think she's wrong at all. But there's consequences to our choices. And if you choose 80%, you're going to be in that trade longer than you may have wanted to be in there. That doesn't necessarily mean that you're going to win more or lose more, but think about the current market environment and how bad things change in just a very small amount of time. So if you're losing more often than you win in a high probability trade strategy where you should already be winning a lot to begin with, one of the first things that you want to adjust is your profit target. Turn it down. Just like the radio, it's too loud, it's too hard hitting. Back it up, back it off. Options Alpha and Tasty Trades promotes 50% win rate or 50% profit. They're really big on that number. Tasty has a lot of backtesting data that says 50% is just about as good as you can get because it's the sweet spot in the time series and it's also the sweet spot in your volatility P&L. Not and we're not even going to get into volatility P&L, but it just messes everything up. So if you can get out around or near 50%, that's just about as good as you can get, statistically speaking, over the long haul. But again, if you're not winning as often as you want in a strategy that should be winning with a high pop to begin with, the first thing you want to turn the knob on is your target profit percent. So I turned the knob, I fiddled around with it, and I like 29%. There's no magic to it. I could have used 28, 31, but I'm going to show you what happens when we change that number. We're going to go in and I'm going to demonstrate why I got to 29. When I was running the strategy, I tried to do what everybody else says to do. I put a stop loss on it. Anybody that knows me has heard me talk about options for a while. You'll know that when it comes to the sell side entry into things, if you're selling options for premium or selling the open, you don't use a stop loss. It will kick you out of really good trades. A trade that you were winning, just your P&L was negative, but there was nothing wrong with your trade. It will get you out of it for a loss for no reason. And so a lot of places will say, use a stop loss, 65, 75, whatever, 2/3. So I tried that. I did. I put it on there, and the results were just horrible. Absolutely destructive. Ruined it. It ruined the entire system. So I did it my way. I took it off. There is no stop loss on this strategy. None. But common sense still rules the day, right? If you're in a trade and price has just completely left you behind, you want to find a way to manage the trade, right? I'm a complex options trader, so I'll roll it, I'll adjust it, I'll try to do something with it. And even if I can't, I can just get the heck out, take my lick, take some punishment, and I'll get out. I'll salvage something, hopefully, even if it's just 10 cents. But even if I can't, I am fully resigned to a 100% max loss. I am, because I know that there really is no way to solve that problem. Either I'm going to get kicked out of good trades for no darn reason, because I tried to use a stop loss, or I do not put a stop loss on and I just hope that I can in some way manage this trade. And I'm comfortable with the max loss. So no stop. And I got to tell you, when an iron begins to lose, usually it's like on a Monday or a Tuesday when these lose, they start to lose on a Monday or Tuesday, you wouldn't want to close it because I've had people say, "Well, I'll just close it if it starts to lose early." You don't want to do that. Statistically speaking, we close inside that box way more than we don't. And so even on the days where we broke outside of the box, if you had adjusted it early, like on that Monday, oh man, we broke outside the box, I better close it. And you close it as a loss. And the rest of us, we took it as a winner because it came back inside the box. Right? Even way back here, a significant, serious breakdown outside the box. Where did it close? Inside the box at the end of the week. So you can't second guess this thing and decide, well, it broke the edge on a Tuesday. I'm going to go ahead and get out and eat my loss. Don't do it. You got to let it play out. So go ahead and assume that when you're putting this strategy together, that it's all or nothing. You're going to get your target profit and get out, or you're going to take that loss. If you find a better way, by all means, do it. I'm not like the definitive expert on solutions to the problem because it is a problem and we all got to figure it out on our own. But that's the way I'm approaching it. Early exit date. There is a reason that they have that on there, but I don't need it. So I'm not going to apply that. I am going to apply an early exit time. And if we need to, we can go in and try to give this like a 0 or a 1 or try to see what the early exit will do for us. But I want to know that we're out of this thing by the end of the day on that Friday of the expiration, right? That's kind of my benchmark. I don't want to get into like 3:30 and 3:45 and 3:50 in the afternoon on a Friday before expiration. Because remember, you got to try to fill these things to get out. And and when it's losing, you're not going to you don't want to struggle, right? So no indicators to get out early. None of that criteria is going to be anything that I need. Now, he mentioned this, Troy did. He mentioned it when he was in the Bullish Bears doing his live stream, introducing all of you to how this platform works. He says, when you put on a back test, don't paint yourself rainbows and butterflies. Make the thing as difficult and as mean and as violent as you can get it. Because if you throw every hateful thing at this strategy that you can think of, and it still tells you that you're going to win a lot and make a lot of money, then at least you know you've given it everything you've got. You've tried to handicap it, trip it, shove it down the stairs, and it still gave you good outcomes. But if you go in and you deliberately try to paint a pretty picture, oh, it'll give you pretty information, right? It'll draw you this beautiful little wonderland story where everything is sunshine and rainbows. So turn on the commissions and fees. If we were trading in real life, we would be paying those. My fees are not $2, but I'm going to put in $2. I think mine's around a dollar 70 something. That's fine. I'm going to make it $2 on each side, even though I only pay to get in the round trip from the entry. But it's okay. I want to handicap it, right? So $4 in total, two to get in, two to get out. Use slippage. This is the SPX we're talking about, right? We know this thing doesn't have as good of a bid ask as SPY. I don't know if that's an appropriate number because I didn't use that before. They didn't have that when I was, or maybe they did and I just didn't use it. We're going to put it in there now. We may have to make an adjustment to that. But $1.25 seems about right. All right, we'll go in and look. We don't want any trade with just drastically stupid bid ask spread. So if you're really, really, really far out of the money, no, it should be dollar values right? Like $1.25. But if we're talking about the SPX, let's actually go look at it. Look at an SPX option. Look at what we got, 690, 720. That's the bid-ask spread right now. So what's the slippage? $10 on each side. What's $10 in the options world? 10 cents, right? 10 cents, $20. So should we make it that? Should we go in and readjust that, right? Like I said, I wasn't using that before. I don't even know what the outcome would be if I hit the button on that. So let's make it, oh, what did I hit? Let's make that, what, 25? Make it $25 on each side. All right, so there you go. Perennic says if you make it more than 50 cents wide, it breaks the system. So let's start with 25, right? Because we don't want to break the system, but we do want punishment, right? We want pain in there because we're not going to get great fills. We already know that. We're going to be out of the money, and especially on the close side, when we're trying to get out of this thing, um, we want it to be painful, right? So we're going to put 25 on each side. We want to require 2 consecutive hits to get out. And that is, you can see numbers bouncing around. Like I've got trades right now, right? I had one that I was trying to fill earlier. And this might show us a number, but that doesn't actually mean that we're going to get filled at that number, right? Just how to roll this thing. We're just really stuck. So I may as well try to get something for it. It didn't help. If we could get that breakout into the end of the day, that would solve the problem. So we know that just seeing a number isn't good enough. We want to make sure that it actually goes back and can hit that number more than once. Now, here's one that I really like, and I'm not going to turn it on yet, but we're going to come back and probably turn it on. Minimum and maximum premium. These trades are $5 wide. If you build a $5 wide credit spread at the money and you can get 250 in the SPX, you're doing pretty good, because usually it's going to handicap you and you're going to get like 210 or something like that. You're not going to like it, but it's good. You know, it's like, well, it's the SPX at the money. It's the best I want to get. But if you got a $5 wide iron condor out of the money with a 25 delta and you can still get half the width of the spread, that is pretty cool. That's pretty damn good. That's a lot of credit. Do we need that? Right? I say I would want it, but if we turn that on, we're not going to get as many fills. So we're not going to get as many occurrences. So we're going to leave it off for the moment, but I want to have in my pocket, knowing that I can do that, that we may come in later on and set an entry premium. It may not be $2.50. It may be a $2. We don't know. Let's see what the results are first, and then see if we can turn this on. And then there are times where you do not want to see a trade. I have my own personal preferences about where I do not want to do a mechanical trade system. I learned because in 2020, I ran 18 systems for the entire year, all the way through COVID, even when I didn't like it. January 25, March 15th, May 3rd, and June 14th. Those are FOMC days. Actually, one day later, right? Because it's Tuesday and Wednesday. So Monday, Tuesday, so Wednesday. I also don't like doing mechanical systems on short weeks, holiday weeks. say like last week, there wouldn't have been one because it was a short week. So if we need to, if we see that this back tester is showing us that those weeks were losing weeks, we can turn those weeks off using that setting. So let's give it a run and see what we get before we start making any adjustments. Days in trade 5.8. So that's different than what we used to have or what I had before. Let's see if anything has changed. Exact days to expiration, 5% of the portfolio, get out by 3 o'clock. Fees, slippage, double price targets, lots of losses. Max loss is way bigger than the max win. So let's go back in. No, before we go back in, let's look at the trade log. Let's see what's going on so we know what's happening here. The 7th, the 14th, the 21st, 28th. So it's catching it every week. Some back tests were skipping weeks. This isn't. So we don't have any criteria that's eliminating any weeks. But we're staying in the trade a lot longer than my previous back tests were doing. And it's getting out at a reasonably decent. Let's add a little bit of rules to this on the credit side. We're getting 220, 215, 230, 220s. So let's add something that says, well, we wouldn't want to add anything at this point for a credit value because none of these are showing a 250. We had one that was close, and that was one of the losers. So maybe too much credit is a little bit of a heads up. Let's see what we want to adjust here. I'm going to put a day on there and see where it puts us. So instead of Fridays, it's Thursdays. It made things worse. Our average time in trade is still big. It doesn't seem to be ignoring any trades. So all the bid ask was decent, or it would have had gaps in the time frames. Let's see what else needs to be adjusted. Let's look at my old results. That's a 1 year. 25, 5, 5. 45% on that 1 year. Use exact days to expiration. Did I miss that somewhere? I don't think I did. Got that. Yeah, let's mess with the slippage a little bit. We do want to throw as much pain at this thing as we can. Well, let's turn that off for a minute because I wasn't using that before. Let's see what's up with the slippage. Well, that drastically changed things. Still not what we're looking for, but it certainly changed things around. So that's a good heads up. And now you can see we're getting things like 250s, 260s, 270s. So if we're going to do that, let's go back in and set a minimum requirement. Let's start with something like 230. And now let's start messing with that target profit. I had it at 29. Let's go to 45 because I got another strategy that's at 45. Made it worse. So holding for longer is not more helpful. And going to 25 just gave us back that one. We still have the one, so 30 is fine. 31 is fine. Just keep bumping it. Keep bumping it until we find that loser that's in there. Still 19. But that one loser, or in this case, the two losers, they're horrible, right? Because of that max loss value. Still at 19 winners. It might even get to 40 on this thing. Try 40. Still 19. Although technically, I guess we should be going the other way and try to get it to 20 winners, right? Because normally when you run a credit spread of any kind, anything that you're selling to open, win rate is not normally your focus, right? And that's because we already know it's a high probability. What we would normally try to work on is the statistics of that. So the reason that it's so important right now is because of the max loss. That's the only thing that's absolutely crippling. Every single loss, whether it's just two losses, is just really hurting this thing. There's 45, and there's the slip. So we went from 19 winners to 18 winners. Let's knock it back just one. See what we got. All right, so 44. If we go above 44%, it brings in one more loss. I would say we wouldn't want to get that close, right? We would want to maintain something below that because on a week-to-week basis, if it's that one loser and we lost because we tried to hold for just 3 more percentage points, that would suck. It probably would be a good idea to put in those FOMC dates so that we don't put irons on in those. But would it be the week of the FOMC or the week after? Because we only had one FOMC week that really caused the blowout, and that was the March 16 FOMC. The ones after that had one up day and then they went down. So those weren't prohibitive. That's what we expect price to do. Make a big move one day and then take it all back again the next day. Yep, I tried that bump a little earlier, and I'm more than willing to add it in again. I shouldn't have cleaned all this up. I had a lot more trade results, and I went in and I started to clean it all up. I went in cleaning house before this stream today, And if we had to, I can go get all the data because I shared it all over at Options Omega. But we don't want some special perfect little thing, right? We want to be able to go in and bump numbers. So the fact that I got rid of my old results, that's okay. We've got new results, right? We got more data than we had in my other tests. I'm going to turn that off for a moment, just see what we get out of it. Nope, that didn't do anything. And I didn't expect it to, but I just wanted to do it. So I changed the exit to 3:30 instead of 3 o'clock, and it added one more trade. It didn't increase our wins. It just increased our trades, oddly enough. I don't know why exiting at 3:30 would add a trade. I can understand if it, you know, gave us a loss or if it gave us a win, but not giving us a trade. All right, well, it's still at 22, so oh, maybe I just seen it move and that didn't make any sense. So what do we got? Open every Friday, exact days to expiration, 5% of the portfolio, and we're opening at 9:45 in the morning on Fridays. Exit trades at 3 o'clock with a target profit of 45%. And what that should give us is around an 87.5% win rate. And it should give us more winners than losers with an average win bigger than the average loss. 25 delta, 7 days to expiration. Let's turn the minimum premium off. That was a weird number to put in. That was a typo. Hmm. That's still not the same information as before. It's all right though. So we still want to figure out, is that 25 appropriate? Do we need to use 26, 27, or 23, 22? And then on the other side of it, on the call side, should the calls just mimic whatever we're doing on the put side, or should the calls be more appropriately placed based on what the average of that green line is? Now, what I had been doing is just mimicking whatever I had on the put side and taking it over to the call side. When we looked at that iron, when I did that today, it made it pretty equidistant. But if you'd have built one of those a month ago, it wouldn't have been equidistant. So that's something to think about too. If we do want to make an adjustment, what would we do with it, right? So like if the puts are 10 strikes out of the money, just random, would we keep the calls 10 strikes out of the money as well so that we keep our trade delta neutral in the middle. And I know at one point when I was back testing that you can accidentally go the wrong way with this, and you can go into a minus day. What I found out is if you put it on a minus day, you actually screw all kinds of stuff up. We were running this back test kind of playing around, and we were using minus days, and we were getting like 100% wins and everything all the time. And it's like, no way you can have 100% win and everything all the time. And it was because I had put a minus day in here by mistake. So you don't want a minus day. I'm going to put close one day early, and we're just going to set that to 0. So it's just going to close one day early. So it defaulted to noon. I don't know how badly that's going to wreck things. Yeah, that wrecked things pretty bad. Let's go back in and get rid of the noon part. We'll just set it to 3:45 or 3:59. We're back up to that 19 winners and getting out one day early. So let's look at those trades for a moment, see if they're going to offer any insight here into what's going on. So we can cut the numbers down, which means when we do get losses, they're not like on a 5 lot or an 8 lot, but that drastically cuts in on the profit side. Of course, the losses anyways were cutting on the profit side. It's the max winner, max loser that's really keeps getting my attention. In all of the back tests that I was running, my max winners were doing better than my max losers. So we're going to take an extreme step in the other direction. Instead of 44, let's use 15. Still didn't change that 19 winners. So we did now finally get the max win up one more, but the numbers are even worse, right? Because now the average winners are really small, and yet that average loser is still big. So let's just go and put a crazy number in there, like what Barbara talks about. Let's put an 80 in there. Really bad. We'll go back to 44. Let's knock this down a little bit. Let's go the other way. Hmm. Now we'll make an adjustment to it. So something different from when I was doing it to today is that the time in trade is significantly longer than it used to be. And I don't know why that is. And then the max loser is bigger than the max win. Now, that could be because of this 2 consecutive hits. When I was first running the back test, I didn't use that. I was talking to somebody over at Options Alpha one day, or Options Omega. I was talking to somebody over there and they said, "Hey, are you using that?" And I said, "No, I didn't really know what it was, so I didn't fiddle with it." They said, "Well, it's just like what it sounds like. You got to have consecutive hits on that thing, and that is going to make the trade more realistic." And I thought, well, I want to make my back test more realistic, so I started using it. That could be why a lot of the numbers that we're getting now isn't the same as the numbers that I was getting then. And I don't want to turn it off because we would want to make sure that the test that we're running is as real and as accurate as possible. So let's look at what we got. We don't have these weekly expected move lines, right? And we're going to try to mimic those to a point. Remember, the reason that the entire strategy quit working is because the size of this box got so big that if we tried to set our iron condors on those lines, we would win frequently, but there wouldn't be any money in it, right? That was the worst part of the whole thing. Now, in 2020, when I was running this strategy and I was running it live, that's when those boxes really started to get big. And I was down on the year a lot. About midway through the year, I thought, well, I've got to come up with something else. I had already committed to the fact that I was going to run it all year. I wasn't going to stop. So I had to come up with a solution. What I had been doing was closing the trade at 50% profit. Because I mean that was the common logic that everybody was doing, right? Like, well, yeah, you put on a credit, you open, for X amount of credit and you close it early, 50%, 70%. I quit doing that about midway through 2020. And instead, I went for maximum profit because I was already taking max losses when they lost. Like there's no way to save these things. Because like I said, on Thursday, you may break out of the box, but by Friday, a lot of times it'll come right back in again, right? Obviously, Thursday and Friday of this week was a big no, but generally speaking, when we break out of the box, most of the time, and we just come back in the box by the end of the week. So you don't want to close them early. You'll just be locking in losses. The argument would be if I'm going to take a max loss, I should on the other side of that be willing to take a max profit. So let's follow that rabbit down the rabbit hole. No target profit. Just going to close the trade near the end of the day on the expiration day. Ouch. That's some horrible stuff. Although we did now start to get a max winner greater than a max loser. We also only have 11 out of 20 wins. go back to 25 delta. We've bumped the win rate up a little bit. And our max winners are bigger than our max losers. So what would they say? We're trending in the right direction, right? And we're not compromising any of our systems. Now we just dropped one, so we went too far. And you know what? I got to say, manually, I wouldn't be holding that close to the end of the day, right? If we were running these and it was on that Friday afternoon, I would be looking to get out of those before we got that close. Was it really that far? Let's see. 13 winners. All right. Let's try to go up one more then. Get a little closer. If you don't know the way the numbers are working here, the higher the delta, the closer to the money I'm getting. Nope. So that 25 is the sweet spot. If we go beyond 25 and we try to get closer to the money, we lose more trades. If I try to back off and get farther away, we lose more trades, which doesn't quite make sense. Let's take it all the way down to a 20. It could be that we don't have the same number of trades, right? Because maybe it doesn't match the criteria. Yeah, that definitely is not what we want. So let's just take it back to the 25. All right, our max win is bigger than our max loss. Our average win is not bigger than our average loss, but they're not very far apart. 13 out of 21 wins gives us a 61% win rate, and it should be at the bare minimum 68% win rate. That would be a 1 standard deviation. We should be able to close inside the box 70% of the time. Right? I mean, that's 1 standard deviation. That's kind of like the default position, especially for the S&P. It's normally that accurate. We are in a high volatility market. We're in an crazy extreme market. I've had people talk about indicators for identifying what an extreme market looks like, but depending on your broker, you may not have all the kind of indicators out there. So let me just show you a common sense, simple way to figure out if you're in a high volatility environment or not. It's so obvious that as soon as I show you, you're going to be like, oh yeah, I should have known. When things are calm and the world is great and it's all sunshine and rainbows, the size of the candles are very small. Isn't that obvious? As soon as you see it, now that you've heard it, you'll never forget it. It's like, oh, I should have seen that. Look at the kind of market we're in now. Look at the size of those candles, how very large, extreme they are. So implied volatility is another word for implied movement, a promise of movement. The current market is violent, is extreme, and that's why the size of those boxes have gotten very big. But it is still breaking the expected move more than it should. And if we continue to try to go farther out of the money with our strike choices, there's not enough profit there, right? So we get a choice on profit. Let's go back and fix that a little bit. Back to the back tester. Suppose we did want to go farther away. Let's see what kind of credit we were getting. Forget everything else that's going to show up for a moment and just look at what kind of numbers were we getting. There's a $2 trade, 210, 215. So even going out to something like a 20 delta, we were able to get some reasonably decent credit. Sure, I mean, there's some 80s, some 185s, 190s. So how about we put a minimum on there, which will cut into the trades, right? The number of trades that we get. But let's put a minimum requirement on there if we're going to use a lower delta, say a 15 delta or a 20 delta. Then we want to make sure that there's a minimum credit criteria. Tasty Trade says you should get around 1/3 the width of the spread. That's one of their like default go-to arguments. If you're going to do an out of the money credit of any kind, iron, whatever. So let's see what a 15 delta gets us trade wise. How much credit are we getting? $1.35, $1.45. There's some 50s. So 50 looks like a good benchmark. Let's see, put that in place. Minimum $1.50 credit. Yeah, but that max loser is getting us, right? Back in here. We're back to the 25 delta. We want a minimum credit at 275. No trades. I went too far. I pushed it too hard. Put a 250. Now only 12 trades, 7 winners. The max loser is bigger than the max win, but the average winner is bigger than the average loser. Still got a pretty horrible win rate. Now you know what I do when I'm sitting in my office at 10:30 at night and you wonder why I'm still on the Discord, because I'm sitting there doing stuff like this, tweaking the knobs and trying to figure out how to adjust these with just a little better outcome. So let's just kind of step back for a minute and review what we've got going on here. Every time we leave the 25 delta, things just fall apart. So if we go any farther out of the money than a 25 delta, we're just not getting enough money. And yet, if we start to get closer than a 25 delta, we're getting too close to price and it's running us over, right? So we can't really leave the 25 delta. We have to stay there. Yep, that's what I got it set at right now, is just to go ahead and let it expire. It says exit at 359. So I mean, I'm as close as I can get it. I don't know of a way to turn it off, right? So that's close enough to expiration. But see, the thing about trying to handicap it and get out early, if you're worried about like, oh, this isn't looking good, I better get out while the getting's good. I better go ahead and eat it at this some kind of loss, then go ahead and take a max loss. If you try that, which is what I tried to do in 2020 when I was running these with live money, is that we come back inside the box way more than we stay out of the box, right? That's the worst of the situation. So if every time we leave the box, you close one of these things down, you can be closing it down every other week. You're going to be closing it down in losses, right? I mean, and the thing is, we don't have to guess. We got the indicator on there, so we can look and say, like, yeah, we went out that week, and I mean, this week was a loser anyways, but we had that week where we went out and we came back in. That week we left and we came back in. And that week we left and we came back in. Those would have just been losses for nothing, right? So you can't handicap it that way. I found that out the hard way because it does fix itself more often than it doesn't, right? And I mean, this week alone is a perfect week where it does not fix itself. And it's funny because yesterday afternoon, after the market closed, when I was running my technicals, I seen that bear market pennant. If I'd have caught that earlier in the day, I would not have put on the butterfly that I put on yesterday, but I didn't catch it until afterwards. That is one of my quintessential bull market exploding trade strategies right there. Like, you want to trade to an upside breakout, it looks like that the day before. Sure enough, what we got today, if I'd have seen that yesterday, I wouldn't have put on the trade that I put on yesterday. So obviously, when we come outside the box, we don't always go back in, right? This is a perfect example of a week where we didn't go back in, but we do normally go back in the box. Now, the main thing today was I wanted to get to a point with the back test that we had actionable trade that we could go ahead and start putting these on. Now, obviously, it's not 9:45 in the morning, so we weren't going to do one today either way, right? We weren't going to do it either way today, but that we had one that we could start using going forward. And I wanted to also make sure that everybody knew how to do what I was doing. And I've been running some examples here. I mean, we've been kind of pushing the buttons, you know, for 2 hours. Well, about an hour, right? I explained things for an hour and then we started pushing buttons. But we've been pushing buttons and kind of tweaking the knobs and making adjustments for a while now. And I know I was doing it fast, but the replay is going to be there. You guys will be able to go back and, watch it again, catch it in slow motion. I want you to know what you can adjust and why you might want to. And trust me when I tell you, I don't have all the answers, right? I don't. I just know what I've had in my own trading when I ran these things, and I was doing different expirations too. I did Monday, Wednesdays, and Fridays. I tried 50%, I tried 90%, I tried everything I could try. Stops, no stops, but all of it was live because I didn't have this back then, right? Like, if you wanted to do it back then, you just had to do it. You had to put real money on the line and go see if it worked. And so that's what I did. And after doing them for an entire year, one thing that I can tell you is you get a lot of experience. People say, wow, you're so new to trading. How did you learn so fast? I just went and put on a crap load of trades. That's how I learned. But that's not necessarily a good outcome, right? Now we don't have to do it that way. We don't have to just run trial by fire, putting live money in. We can check first using this platform. And we're going to continue to do this. I'm hoping two days a week at least, we come in, we bring in the back tester, and whether it's the iron, the butterfly, I don't care what it is. Let's work on the mechanicals and bring these things back again. I miss having my mechanical trades. I can't tell you. It sucks not having them after you get used to having these default automatic trades that just get put on every week. I loved them. So I want them back again. We've been at it for 2 hours. It's Friday afternoon. We didn't get a solution that I thought we were going to get today. We're not getting the numbers that I had got 2 weeks ago when I was running things. And I really think it's because I wasn't pushing them using this ignore trades. Because if I turn that off, or if I turn off the other one, the one that says it needs to double tap your profit, that will make it sunshine and rainbows. But we don't want that, right? Don't blow smoke at me and tell me everything is great and wonderful when in the real world I'm going to get chewed up like I got shoved in a lawnmower, right? So maybe I wasn't using all of the strict criteria, and that's fine, because if we pretend that it's all going to be simple and easy and then we start getting those losses, that just sucks. I'd rather get it all figured out right now. We didn't get it today. That's fine. I'm not done with it. And I really hope that I've given you guys something to think about, that maybe you go and you get it for yourself. You try back testing things, um, share our results, kind of look it over, try to figure out, hey, what can we do to increase things? We already know, and it's sometimes easier for the newer traders if we talk about where these numbers come from. So here's my delta column. And when it comes to delta, the smaller delta value, the farther away from the money you are, right? So when you're making those adjustments with the delta, if you go smaller, you're getting farther away from price. And if you go bigger, you're getting closer to the money, right? So farther from the money and then closer to the money. 25, I tried to do a 20 and I tried to do a 30 and I tried to do a 25. 25 is as good as we could get. Anything beyond that started to cause extra losses, more losses. So that seems to be the sweet spot. Now, this broker, while we're here, and we're going to wrap it up for the day, but what this broker has that other brokers doesn't are these blue lines right here, this blue dotted line. And what that line is there to tell you is where is a one standard deviation within the options chain itself. It's right there. Now, that's not expected move, because if we look at the expected move, it's $100. And that number is marked right here with this orange bar. And that happens to be right around a 22 or a 23 delta. Whereas a one standard deviation within the options chain is sitting out here between a 14 and a 15 delta. So it gives us an argument about where we should be landing, right? Remember, we're using a 25, but we're not even using the full expected move. And we're definitely not going way out there. So we have more things that we can try. I'm going to wrap it up. I do think we got a lot of answers today, things that we know we can't really adjust. And what we still have on the table, choices that we can adjust, things that we can still kind of kick the tires and try to figure out better, is maybe the minimum credit entry, that we're getting at least 1/3 the width of the spread, which by Tasty standards, that would be like $1.66 and a $5 spread. Well, if we looked at the trades, they were already getting that or better. So we don't necessarily need to put that minimum requirement on there at that point, because we were already doing better than that. I would say if we want to use a minimum requirement, we want to make it worth our while, like 50% of the width of the spread. So make adjustments on the delta, realizing that a higher delta gets you closer to the money and a lower delta gets you farther out. Maybe try to find, I'm using a 25 because that's where this put side was statistically. but maybe that's not as good, right? We were looking at the expected move for the week, and it was actually putting us at like a 20 delta or 22. So we can make adjustments there as well. I was using 9:45 because the later time period was just a horrible result that it wasn't even remotely close to what I would have expected it to be. But that was 2 weeks ago. And there's obviously something that's changed in here. So the time of day for the entry could be one of the things that we want to think about changing. I believe the next stream that we're going to do is Tuesday afternoon. We're going to try for 1 o'clock. If that changes, I will put it in the chat and let everybody know that that time won't work. But I'm wanting 2 of these a week, and Tuesdays and Fridays in the afternoons, I think would be a good fit. All right. So that's what we're going to aim for. There is an affiliate link. If you guys have gone over and you looked at the Options Omega and you want to check it out, you can get 50% off if you use the affiliate link. The Bullish Bears has one on their website, and I have one on mine. So you've got multiple places to find it. On my website, it's at it's on the right hand side. So just jump over there and look. It's right there, right? So you can't miss it. I don't exactly know where it is on the Bullish Bears website, but it should be there. So when you go to Bullish Bears, if you type in Options Omega, it'll probably take you to one of our blog posts, and you'd see the webinar that Troy had done and probably find the link there too. Either way, get your 50% off. And if we dial in just one of these strategies, it's going to pay off the entire year. And we've got 18 strategies to do, at least 18. So we've got plenty of things that are going to pay off that subscription for the year. And other than that, guys, have a good weekend. Rest up. We're going to come back at it again on Monday. Just back to regular business. The options class, while I'm here, just might as well hit it. The options class is going to start this weekend. We're doing 8 weeks of Saturdays and 2 weeks of Tuesdays. Obviously, the Tuesdays aren't going to be starting in the next 2 weeks. But if you want to know more about the options class, when you're at the Bullish Bears Discord, just go up to the welcome and go to coaching. There's a video there and a little update so you know how to get a hold of me. And I will see you guys Monday morning for the live stream, the morning briefing.